Okay, sorry for technical difficulties and the late start there. Welcome back to Eat, Sleep, Breathe Real Estate for Season 2, Episode 1. We're going to go into some updates on the mortgage rules, and I have Carmen with me.
Hi, Candace.
Hi. How long have you been in the mortgage industry?
Oh, over 30 years. I actually started out west where mortgage brokers originated.
Nice.
So I got good training. So
that's good. That's good. And you, I know you have some awards too.
Absolutely. In 2014, I was actually selected as one of the top 8 women of influence in the Canadian professional mortgage industry.
That's awesome.
And Best Community Service Award for the community work I do with Angels in the Night.
And what is Angels in the Night?
Angels in the Night is homeless shelter project. And there's actually 14 chapters across Canada, and I lead the London one. In December, we were able to deliver approximately $35,000 worth of brand new stuff to 6 homeless shelters.
Nice. Yeah, I know when we originally met, I had wanted to work with you because I knew you did a lot of charity work, and obviously you do a lot of business. So when there's tricky mortgages, I've been working with Carmen for a bit now. I always send my tricky clients to you.
Now remember, don't only send your tricky clients, because a lot of my clientele are also doctors and lawyers and so on. Because of the fact that I deal with so many lenders, I can always select the very best rate and product to match up the clients with.
Perfect.
So I can beat a lot of the bank rates because of the volumes that I do.
Perfect. That's good. So what we're going to talk about today is the updates, and just in case there's people watching that don't know anything about mortgage lending at all, I'm going to start with the most basic of questions, and then we're going to answer them. Firstly, the differences between what you can put down for a down payment for first-time home buyers and what you can put down for a down payment if it's an investment property. What's the difference there?
Well, as a first-time home buyer, and they're still allowing up to 2 homes, you can still put the 5% down. However, your qualifying rate is what's going to be the big kicker here. A lot of people don't know what the difference is between the benchmark or posted rate and the discounted rate. So all the big 5 banks across Canada have what's called a posted rate, which today would be like 4.95.
Okay.
So here's the difference. If it's an insured mortgage, which we'll go into, then you only have to qualify at the benchmark rate, not at the discounted rate. So if the bank is offering 2.8 on a 5-year term, you still have to qualify at 4.95. Okay.
I just want to back up and talk about the basics first, because if we go right up, it might go above some people's heads. So what I'm talking about initially is that for a first-time home buyer for a down payment, you can put 5% down, but for income properties, you usually need 20%, right?
20% down.
Okay, so what kind of income properties can you get away with less than 20% down ever?
If it's a rental and an owner occupied, then not every lender, but a lot of lenders will look at that with less down payment, as long as you're owner occupying part of the property. Okay,
that's good to know. For when you're putting down payments down, has anything changed for the percentage from last year till the new mortgage rules that are in now for January 2018?
Not on the
not for the down payment amount?
For the down payments amount. No.
Okay. What about for investment properties?
They're getting a lot more strict on investment properties. So lenders like to look at the whole picture. It's not as easy, and a lot of lenders are also cutting back the amount of rental properties one can own.
Yeah. Okay, so that is a difference from the old rules to the new rules?
Bigger difference.
So in general terms, it's getting stricter?
Yes.
Okay. Oh, we got a phone call. I'm just going to decline it.
Perfect.
Okay, cool. Okay, so besides just the down payment, when someone's looking to buy a house, I know that credit is important. So just walk me through, has there been any changes for what credit rating you need when you're going in to qualify for either your own home or an investment property?
Absolutely. Banks actually look for reasons to turn down. The government has already made the changes before that in Canada to get a bank mortgage. Beacon score had to be 620.
Okay.
They've moved it up. There are alternative lenders, which is another whole discussion.
However, but for the most people, the average Joe and Josephine,
if the bank doesn't see a 650 plus minimum Beacon score, they look for reasons to turn down the file.
Okay, so we talked about down payment, we've talked about credit score. job letters and income, is there going to be a difference for what people need for their income as opposed to what they needed in December 2017 for now January?
They're getting a lot more strict with that as well.
Okay.
So be prepared to have at least 3 proofs of income.
Yeah.
One of them being a recent pay stub.
Yeah.
Letter from work, and always a notice of assessment to show that there's no income tax owing.
Okay.
On a business for self person, which is also getting a lot more strict, business for self has to have at least 2 years complete T1 generals,
Yeah.
as well as notice of assessments. Lenders are asking for bank statements to see money's going in,
Mm-hmm.
and it's a little tougher for hairdressers and people who have
Self-employed and realtors, always for
Yes.
self-employed. So
and mortgage brokers.
Exactly. Okay, so the job letters and the notice of assessment. Do you want to just explain what a notice of assessment is in case someone doesn't know? Because I want to keep it really basic for this first episode.
Absolutely. A notice of assessment is what the government sends you back when you file your taxes.
Yeah.
And it usually shows how much RRSPs that you can buy,
Mm-hmm.
and it shows if you're owing the government, and if the government okays
Yeah.
the submission that you did with your T1 general.
For sure. So credit obviously is important to keep high when you're looking to buy for yourself or an investment property. But another thing, the notice of assessment means you need to file your taxes. So if you're watching this and you haven't filed your taxes for last year or the year before, last year is pretty new, then you need to do that. If you forgot to file your taxes for 2016, could you file them this year and still show that letter, and would the lender still consider?
Absolutely, as long as the accountant is backing it up. If you're doing your own personal taxes,
Mm-hmm.
the lender will not look at it until you
Okay.
hear back from the government, definitely.
So the accountant's more reliable than the person.
Absolutely.
Okay, cool. Okay, so we talked about kind of like the basics. I know that from a little bit about what I've been reading, but I'd like you to expand. They want us to apply and qualify at a higher rate than what we used to qualify for. I'm talking about us, people trying to buy investment properties. What's the difference in what we have to qualify for, and what was the rule last year, if you can keep it in really simple terms, and how is that changing for the interest rate?
Okay. Last year, people would be able to qualify at a fixed 5-year term,
Yeah.
whatever the banks are offering.
Yeah.
Those are called discounted rates, by
Yeah.
the way, because every bank in Canada have what's called a benchmark or a posted rate. So today, the 5-year benchmark rate would be 4.95.
So you have to qualify at 4.95% for whatever your current income is. You have to be able to pay the mortgage at 4.95%.
Absolutely.
Okay.
That's if it's insured. Now, if it's not insured, lenders are looking, and if it's a variable rate, collateral mortgage, lenders will qualify at the benchmark of 4.95 plus 2%,
Okay.
which makes it more difficult. So obviously the government wants to see the mortgages insured, even if it's 20% down.
Yeah, I know you have a chart there that shows us what you have to qualify, or what you can afford as opposed to December of 2017, and what you can qualify for now if you're putting 20% down. And we're going to come back to the CMHC thing in a moment. So we're looking at the numbers here. So you could get 273 for a mortgage, and now you're only getting 222. So that's 50 grand. 50 grand less. So this is what my fear is that people are going to qualify for less mortgages, so they're going to be in a smaller price point. Can you be affected by anything if you already bought at this price point?
No.
No. Okay, so you're safe if you already bought in December, and there's also some people that have locked into rates from December. Is that right?
Anybody who's in the system before January 1st, the old
They can
rules
still do the
apply.
old rules.
Absolutely, even if they
Perfect.
close in March or April or a new build, as long as they're in the system before January 1st.
Perfect. Well, that's good for the people that are already pre-qualified. Bringing it back to basics, why do you think it's important to get pre-qualified before you start looking for a house?
For one reason, it's very, very important to be pre-qualified, to know, first of all, exactly what you can purchase on how much.
Totally agree.
Price. Also, it's good to get your documents in up front.
Mm-hmm.
Sometimes people have gone to their bank, and the bank puts in some figures and says you're pre-approved.
Yeah.
They put in an offer, and then they come running to me and say, my bank pre-approved me, and I'm not pre-approved, and that's because there's conditions. So using a mortgage broker is very wise. First of all, because we deal with all the banks, we know what all the banks want, and we will get your documents up front. So when you do put in an offer on a property, you'll already be totally pre-qualified. You'll have all the documents in, including down payment, which lenders look for 3 months worth of savings. So 3 months bank statements to prove that the down payment was saved. Any deposits over $1,000 will be questioned. Very important.
Yeah, but if it's maybe from like rental income or something for someone who's an investor buying again, you can just prove that with like a lease or
with the lease agreements, and income tax will show that. And also very important, most lenders will use 50% of the rental income towards their income.
So breaking that down, that's meaning that if you already own a rental property, they're only going to use 50% of the rent that you have on your lease for that when they're considering what you can afford when you're purchasing another one.
Absolutely.
Just to break things down. I just want to keep it simple because I know some people don't know a lot, and I know we get caught up in mortgage and realtor jargon, and breaking it down for the average person is what I really want this to be about. So, what else? Is there anything other than, I guess we've mentioned all the basic things that are changing now for January. So is there any questions I haven't asked you about that are going to be changing going forward?
Well, there's one thing that's very, very important because of the interest rate hikes.
Okay.
The next...
oh, because it happened yesterday too, and that was something else I wanted to touch on.
It happened yesterday, but what I'm still suggesting is if you already own a home, you're still okay on variable rate. They're not supposed to check for a hike until March the 7th, but I don't believe, and the economists I go with, Benjamin Tall, don't believe that they're actually going to do another increase.
So how much did it increase yesterday?
I don't have the plan.
No worries. That's okay.
So it usually takes a day for everything to reflect.
Yeah, no problem. I was just listening on the radio, and I knew it went up a bit yesterday, and I know it always takes like a month for my mortgage company on one of my properties is variable, and I always ask that question, is should I lock in on that one property? But the variable rate that I originally got is still actually lower than what the fixed rate would be. So
absolutely, but prepare yourselves for the future because the rates have they're lower than they've ever been in over 200 years.
Yeah, that's another thing I like to talk about. When a lot of people like fear mongering and talking about the negative parts about being a landlord and investing, well, I think they're just trying to cut down their competition, because anyone who's an investor or a landlord is going to try to deter you from becoming their competition, because people that own a lot of investment properties continue to buy them. People that have a lot of student rentals and stuff, they still continue. What I tell people when they're investing is as long as the payments in a good market are still going to run the house, then it's still a good investment. If you know the payments are going to go up and the student income and the rental isn't going to be covered, then don't buy that house for sure. But everything that I've been in recently with investors, it still qualifies for making some money by the month and coming in at the end of the year with some good capital. So, is there anything else that's changed for first-time home buyers that you want to touch on?
I believe that the biggest thing that's changed is that the lenders are looking more at documentation, and they're wanting more documentation, and
so more evidence,
qualifying at the higher rate.
Yeah,
exactly.
And so higher rate, you have to qualify for higher payments, you have to prove more, and your credit needs to be higher.
Absolutely.
So they're making it essentially more difficult for people to get houses at this point.
Yes, they are.
Okay, so I'm going to be having Carmen in February and in March, and I'm going to be doing 2 seminars coming up. One of them is going to be a first-time home buyer seminar, so you can come in live. We'll probably do that one live as well, but you can come in, you can ask questions to Carmen, you can ask questions to me about first-time home buying. I'm going to go over the basics of investing in London. One of them is going to focus more on Airbnb and student rentals, and the other one's going to focus more on first-time home buyers. So if you want to come to either one of those events, just send me a text. Let me know you're coming in. The phone number is 519-619-5337. I just need to know for numbers because I'm going to bring some food and snacks to feed you guys while we feed you guys with information as well. Ooh. And That's pretty much it for me. So do you want to add anything else?
Absolutely. When you are looking at purchasing a home, there's a lot of products on the market. Clients, people, you and I have been brainwashed for years and years and years that the most important thing is the rate. Rate is very important, I agree. However, that's not the most important thing because there's so many products out on the market. Ask me about my 10-year plan because in 5 years from now, we will see 6, 7, 8%. I don't believe in locking in on a 5-year right now, and I believe in dealing with an institution. Right now, you can get a good 10-year at 3.74.
Yeah.
And that's probably the way.
So you could lock in the rate for 10 years.
And
just to break it down for other people.
You pay a little bit higher of a premium, but if you look at the 5-year rates, it's not that far.
So if the mortgage rates do go up, which you think they will, then people can still lock in at what is a reasonably historically low mortgage rate, and it will be locked in for 10 years.
Absolutely. And don't be worried about that you have to stay in the property for 10 years because these mortgages, they're portable, so you can actually take them to your next home.
Yeah, because I hear a lot of fear with people when we talk about fixed and variable mortgage rates. And people don't want to do fixed because it's harder to break it. What kind of fees can be associated with that since you're bringing up signing in for a 10-year one? Okay, so beware of collateral mortgages. That's another question that you can ask me on a variable rate because not all variable rates are alike. Yeah.
You need to have a variable rate that has the option that you can lock in to a longer term, number one. And if you are in the proper variable rate mortgage, you should have only a 3-month interest penalty. That's it. So that works out to actually less than 3 months worth of mortgage payments.
Okay, so if someone's paying, if they have a little condo and they're paying $600 a month on a mortgage, then they're just looking at about $1,800?
Exactly.
Okay, so that's not too bad then, and they're locked in, and they still lock in that good rate for 10 years.
Yes.
Yeah, there's so many different ways to do mortgages, and I don't want to get too complicated in the first episode, but I do want to focus on potentially that topic for another episode. I do think we touched on most of the basic stuff, but if you guys have any other questions, please text me them. You can comment on them when we're going live. You can post them on my YouTube videos. We want to know what you guys want to know. And then we can also make the seminars that are coming up kind of focus on what you guys want to ask. And then it's going to be more beneficial to you guys. Basically, we're just trying to get some free information out there. And if you have questions, just call direct for sure. Okay.
Okay, I will be posting on my Facebook site. I will be posting some very good information, including rates, including what you actually, examples of what you can qualify for and how to go look at it.
Yeah, so stay tuned. We are live on both Facebook feeds right now. We will post the information so you can actually see in numbers that Carmen brought with her what you'll qualify for under the new rules and the other stuff. I'll post the links to that stuff in mine as well.
Stuff about the interest rates and looking at the future.
Perfect.
So I will post those on my Facebook page.
Okay, great. Okay, well, thanks so much for joining us, and we look forward to all your questions. So definitely send me a text with your questions, and we hope to see you at the seminar.
Bye.